Hi, this is Jim Cunningham. We're going to talk about 7 hidden death taxes. So here's the problem. I'm a lawyer. I'm totally biased on my view, and most lawyers don't think of it this way. Most people don't think, what is a hidden death tax? Because lawyers would say, Jim, that's ridiculous. It's not really a death tax. It's something else. But you talk to a normal person and they're like, wait a minute, somebody died and the taxes went up or the taxes were accelerated. That's what we're talking about. So when somebody dies, whether it's federal, state, or local government. And if you're a lawyer watching this, this was going to require you to change a little bit of your brain structuring. And we do get a lot of lawyers watching these videos. I know because they call me. And if you're a lawyer and you want to reach out to me, go for it. But these are taxes that kick in or that are accelerated or go up or are paid because somebody died. And that's what we're talking about here. What we're really talking about is this death is a consequence that increases a tax bill. And what sort of gotchas or hidden traps do we have? Well, we have 7 hidden death taxes. They're income tax and something called income in respect of a decedent. We're going to spend a little bit of time on that because that's one that it's a real gotcha that people aren't aware of. We're going to talk about state death and inheritance taxes, property tax. Property tax is going up in California, right? Losing Prop 13, capital gains tax, generation skipping, and inheritance taxes, and the joint tenancy death tax. And we will round it out with where your trustee lives. Now, you would not think that this is a hidden death tax, but as you will see, number 7, it can be a biggie. It can be 35% if you pick the wrong trustee. So, and don't do what you're supposed to do. So if you're watching this on YouTube, please subscribe to our YouTube channel. We really appreciate it. Please post questions, comments. I personally answer those questions and comments on our YouTube page. So go ahead. I really encourage you to post away. I'm Jim Cunningham. I'm a partner at Cunningham Legal. I've been an attorney for 30 years. I am a certified specialist in estate planning, trust, and probate law. I'm a real estate broker, securities, and insurance license, and a pilot single engine land. I'm also on a state bar committee that recertifies certified specialists, and I am currently working on the questions that will go on the certified specialist exam here just in a few days. The state bar will send those out and get comments. So I'm involved in the certification process. Kind of cool stuff. These are the lawyers in our firm. We are dedicated to all things, peaceful transfer of wealth from one generation to the next while minimizing taxes, which means we handle real estate matters, trust administration, corporate matters. Typically, it's for families with a real estate portfolio or some type of family-owned business. This is a disclaimer, super important. I'm a lawyer. I'm talking. Please don't listen to this and just say, "Oh, Jim said," and I'm going to go do this stuff because I said. You really need you need legal advice. And as we go through this, you're going to see you need some accountancy advice as well. But a lot of legal advice on a lot of the things we're talking about here, how to avoid these, really does require savvy, expert legal advice. So what are the hidden death taxes? One of the hidden death taxes is income tax. That really is a death tax. You might say, Jim, what are you talking about? Well, what I'm talking about is, first of all, we have to define income. Income is defined as your gross income, which is all income from whatever source, wherever derived. So compensation for services. If you are inheriting from somebody and they happen to die in November, let's say, you see some money in a bank and you go, wow, that's my inheritance. I get to keep that. Well, that person who died, if they're working, they have to file an income tax return. So you need to just mentally get around, if they have not paid sufficient quarterlies, or you might still owe quarterlies, right? It's very important to pay attention that just because money's sitting in a cash account does not mean that there's not a tax bill. So you still have to finish out the last income tax return from the decedent. Business income, gains on dealing with property, that's capital gains tax. We'll talk about that. The big is interest, rents, royalties, dividends, annuities. We'll talk about that. Annuities, very important, and life insurance proceeds. That's if the premium's if the premium is deducted. So life insurance passes tax-free, but if you have a business and you say, gee, I'd like to buy some insurance to cover obligations if I die, and you die and you've been deducting those premiums, then that death benefit is deductible. So if you don't want that death benefit is taxable. If you don't want that death benefit taxable, you should not be deducting those premiums. Again, talk to your CPA, talk to the person who does your tax return. Pensions, discharge or forgiveness of debt. For you attorneys out there, if you say in an estate plan that if you don't carve out a note being distributed to an individual beneficiary, even though you're distributing a note in the residue, that could be considered extinguishment of death. So it's very important. So whenever we are distributing a note, we want to make sure that that's included as a specific gift in the estate plan, and certainly if it's a child, rather than in the residue. So if you've lent a child $100,000 and it's in your in your estate plan to say, I distribute everything equally to my children, including this note, then that could be considered taxable as income. So a little bit of a gotcha there, even though there's no money to pay. So again, if you're a lawyer, think about this. If you're not a lawyer and you've done an estate plan, and if you lent money to kids and it's time and you're thinking, I want to distribute that note to the kids, just has to be done artfully to avoid that tax trap. Income from an estate or trust. Estates or trusts do have income, right? If there's a trust or estate that's open for a year, it's going to have income. You're going to have to pay money. So income tax is a form of a death tax. And what we're going to talk about is the acceleration component with this income in respect of a decedent. That's a real important one. And the tax on income is a percentage. So the more you make, the more you pay. Most common income tax traps we see: IRAs, we're going to talk about that, annuity, life insurance if you're deducting the premium, or the installment sale. Okay, we're going to tackle each one of these individually. Income, much of what a person inherits, just before we get in there, much of what a person inherits, if it's a family home, if it's real property, also known as real estate, a death benefit on life insurance if you're not deducting the premiums, cash, stocks, bonds, mutual funds. Broadly speaking, those are not taxable as income. Things that are typically taxed as income or income tax to the recipient are IRAs and 401ks that are not a Roth. So newsflash, that IRA you have, that $1 million IRA, when somebody inherits that, at some point they're going to have to take the money out. And in California, it's going to be over 50% tax if it's taxed at the highest rates. Gains on annuities. So if you put $100,000 in and the annuity is worth $500,000, that $400,000 gain is taxable as income typically in 1 year. We're going to talk about a way around that. Income of a decedent during the calendar year of death. So somebody's worked, again, I mentioned this before, somebody's worked and they may die in November. You're going to have to file an income tax return for all that money earned during that year. So that's going to be not that money that was income that was deposited in maybe an account. You're going to have to pay tax on that. Dividends and interest income, pretty obvious. And then the installment sale. So we're going to talk about what that is and why that's a bad thing. So inheriting an IRA and taxes. So let's say Abel dies in 2025. Now, Abel has a fairly large estate. Abel's got $10 million in stocks, a $4 million house, and a $1 million non-Roth IRA. Abel leaves everything to Baker. Well, in 2025, basically 14 million passes tax-free. $1 million is taxed at 40%, or about $400,000. So I just want you to think about this. $15 million estate, it pays a $400,000 in estate taxes. That $400,000, you can look at it several different ways. You're avoiding capital gains tax. If it's done right and all of this is included in Abel's estate, you're getting an adjusted cost basis. So that's a savings of up to over $5 million in capital gains tax. In California, it's 37.1%. 20% long-term capital gain plus 3.8% net investment income tax plus 13.3% state income tax. It could be potentially higher if you have recapture depreciation at 25% instead of the federal 20%. But the idea here is this IRA not only is subject to 54.1% income tax, it is also effectively subject to a 40% death tax. That is 94.1%. So if you have a large estate and you have an IRA, you need to understand that your IRA is taxable both in your estate and subject to income tax. Now, you do get a little bit of a deduction for estate taxes paid, and I'm going to walk you through that. It's pretty complicated, and I think a lot of people don't actually end up doing it because it's kind of like going to Europe and buying something and trying to get your VAT back. Look, I've been to Europe. I've tried to do that. It doesn't seem to work out, and it's like, I'm just leaving, whatever. So you think you're saving money when you're shopping in Europe, but it's kind of hard to get that money back. It's kind of like that with inheriting an IRA. So if Abel timely converts an IRA to a Roth, pays the $541,000 in income tax, the estate saves $400,000 in federal estate tax. Very important. If you have a large estate, the takeaway from here, if you have a taxable estate, so if your assets, if you're an individual, they're over 14 million or over 28 million as a couple, and you have not converted your IRAs to Roths, take a look at that, because the conversion to a Roth effectively can save your family a lot of death taxes. So that is just kind of a thing that to put away in your memory banks there. Don't forget that Roth conversion if you have a taxable estate. So 95%, does this sound familiar? It's a song. I won't sing it because YouTube will flag it. We can't put the clip on here. Let me tell you how it will be. There's 1 for you, 19 for me. meaning you get to keep 5%, 95% goes to the government because I'm the tax man. Should 5% appear too small, be thankful I don't take it all. That is IRAs. So this tax man was written for IRAs in the United States. If you're wealthy and your kids, let's say, go to inherit that IRA, potentially a 95% in tax. So looking at this another way, Baker inherits this $1 million IRA, $370,000 in federal income tax, 3.8% net investment income tax, 13.3% California tax, and 40% federal estate tax, for a total potential of $941,000 tax on $1 million. Now, can you deduct estate taxes on your RMDs from IRAs? Yes, it's hard. What on earth am I talking about? When somebody inherits an IRA, they have to take that money out. They're either going to not have to take anything out for 10 years. They might have to start taking money out the year after the person who owns the IRA passes away. It depends on if that person who owns the IRA has started their RMDs or not. If you have not started your RMDs, your heirs don't have to take that money out for 10 years. If you have started your RMDs, they have to take it out. It's kind of the high-level rule. I'm not talking about eligible designated beneficiaries, which is chronically ill and disabled beneficiaries. They always are going to have to take that minimum distribution. Internal Revenue Code Section 691C allows a deduction for estate taxes paid on what is called income in respect of a decedent. So IRAs are what are considered income in respect of a decedent. Now, I don't want to get too in the weeds on this, but I'm trying to save you money. If there is estate tax paid and you inherited an IRA and you are taking RMDs, you might be missing out on a pretty significant income tax deduction, is where I'm going with this. So this offsets the double taxation. It's what I talked about, that 40% death tax, 54.1% income tax. That is by definition double taxation, but there's a deduction for the proportion that is related to your RMD. So let's make this really simple. I know I'm slightly changing the numbers, but this is to understand the concept. If a person has a $10 million estate and $1 million was IRA, and the death taxes are $2.6 million, $260,000 is allocated to that IRA. So in the previous example, I said that if you have a $14 million estate and then you have another $1 million, that IRA is effectively taxed at 40% because it's in your estate. If that IRA weren't in your estate, you wouldn't pay any estate tax, right? You wouldn't pay any income tax. So what we're talking about here is if you've already inherited this IRA and you're like, oh man, this tax thing is a real drag. If you've already inherited the IRA, in our example here, you can basically take a 26% income tax deduction is how the math works out. So it's proportional. If your IRA that you inherited is $1 million and the tax was $2.6 million, and your IRA was 1/10 of the estate, that means you have a $260,000 effectively income tax deduction that you can take. So if your RMD, let's say you've inherited this IRA, you have to take out $50,000 in a year, there's $1 million in the IRA, you would get, under this example, a deduction of essentially $260,000 divided by 20, which is 5% of the $1 million IRA, which is $13,000. So when the $50,000 RMD is reported on your 1040, you're eligible for a $13,000 deduction. That's if you itemize your deductions, right? I mean, there's a whole bunch of stuff that goes in here. So basically, what do you have to do to claim this deduction? So where I'm going with this is you've already inherited the IRA. How do you pay less income tax? You report the RMD as income on your Form 1040 line 4B. You deduct the estate taxes on the required minimum distribution. It is not subject, it's other itemized deductions. Again, if you don't itemize your deductions, you're going to lose this. But you do have to get to the Form 706, which is the federal estate tax return from the executor, the estate tax breakdown for the IRA, and keep your calculation records for IRS inquiries for up to 10 years or more. A lot of work. I will tell you, this is where a lot of law firms absolutely fall down when it comes to trust administration. In our firm, we do a very complete trust administration. We give each beneficiary, this is if the trustee hires us to do this, which we recommend, we give each beneficiary a binder that has all this stuff in it, right? So if a beneficiary is inheriting an IRA, they're going to have all this information in there so that they can pick up that deduction. And that's a $13,000 deduction for that RMD. And the maximum income tax deduction is $260. But that's, in California, it's worth $100,000, $130,000. So a little bit of a benefit there. So how can you protect an IRA? So one of the other things that I would say a tax on an income tax on IRAs or a tax on IRAs is absolutely no planning. So somebody inherits an IRA and then gets a divorce. Is that going to be subject to a 50-50 division of community property? I have no idea. It might not. It's inherited, But what you do with your inheritance after you receive it, you can certainly transmute that to separate property. So what we do for a lot of our clients with who have the larger IRAs, maybe $1 million IRA, we put a wrapper effectively around that IRA, which is the IRA Legacy Trust. I cover this in my book, Savvy Estate Planning, What You Need to Know Before You Hire the Right Lawyer. The link is in the notes. We go kind of in depth on asset protection for beneficiaries, protecting it from divorce, protecting it from creditors and predators. And what this is this is an IRA. Instead of going to the beneficiary, so Abel's IRA went to Baker. Instead of it going to Baker, it is Abel's IRA trust for the benefit of Baker, right? So it goes into a special IRA Legacy Trust. This is something that must be set up by Abel, right? It has to be set up by the owner of the IRA account, not the beneficiary after you inherit it, but it's set up by the owner of the account. And one advantage is you can name a third-party trustee, and you can direct the trustee, hey, trustee, I want you to take care of all the paperwork. I want you to get that 706. I want you to calculate my deduction. And oh, by the way, for money that stays in that IRA trust, if it happens to be in Nevada and it's not distributed to you, it is not yet subject to California income tax. So you're getting a bit of a benefit there. Really take a look at that. We cover that in our book. Let's look at annuities. Charlie invests $100,000 in an annuity in 1990. When Charlie dies, the annuity's grown to $600,000. So it's gone up $500,000. This is fantastic. Charlie's not married and names Delta as beneficiary of the annuity. The year Charlie dies, the $500,000 is taxable as income to Delta. That's it. Delta's going to add $500,000 to her income that year, pushes her income way up, pushes her safe harbor. So the following year when she makes estimated payments or maybe makes an adjustment on her W-2, she's got to add, she's got to, reduce withholdings, right? So her paycheck may be less if she's working. But the year Charlie dies, that $500,000 is taxable. Charlie can, and we've covered this in other webinars, can do some planning before that happens. So if you have an annuity that's gone up quite a bit and you're not leaving it to a spouse, so there's some different rules about spouses. This annuity, so Charlie could have set it up so that Delta could take that $500,000 gain over Delta's life, which might be 30 years. So it's, 100, not that much money, 15,000, whatever the math works out, over 30 years. So she could stretch that taxable payment coming out. So the year that Charlie dies, maybe 15,000 comes out, but 485,000 stays in and is working for Delta. And instead of Delta paying that money out in tax, paying that $250,000 in tax or $300,000 in tax, that money's working for Delta over the years. And when you model this out, if Charlie can rework his annuity, and this is what we do with a lot of clients, rework the annuity so that when Charlie dies, the payments to Delta are spread out over time. It really reduces, it creates a lot more intergenerational wealth is where I'm going with that, right? Might not actually reduce the tax bill, but might end up with more money in Delta's pocket over time. Life insurance and income tax. Life insurance is normally free from income tax unless you deduct the premium. So if you're a business owner and you pay $1,000 a year for $1 million premium, you're a young person, and you're deducting that $1,000, not that big of a benefit, that $1 million is going to be taxable as income. So really pay attention to that. And this is serious stuff because there's an IRS Form 712 that's issued. That life insurance not only is includable in your estate, and the IRS does report it, or the insurance companies report it to the IRS, that not only is included in your estate, but again, if it's subject to income tax, it could be potentially a double whammy. So Wanda buys life insurance with $1 million death benefit. Wanda dies. The $1 million death benefit is subject to 40% tax, death tax, but not income tax if Wanda hasn't deducted the premium. So there are ways that we can keep that life insurance benefit outside of Wanda's estate, and that's through an irrevocable life insurance trust that we cover in other webinars. The income tax in respect of a decedent and the installment sale. So clients will come to us and they'll say, Jim, I'm trying to figure out ways to minimize tax. And we do cover this in other webinars, the installment sale. So instead of, and the example here is a great example. Echo buys a home in 1974 for $100,000. Echo sells that property in 2024, right, 50 years later for $1.1 million. But Echo structures the deal as an installment sale. So what does that mean? So over a 10-year term, Echo is realizing this $100,000 capital gain instead of the $1 million capital gain, instead of in 1 year, recognizing that over 10 years. Now the benefit is you're going to pay significantly less capital gains tax, okay? Assuming Echo doesn't have much other income. The idea is to slowly get paid this 100,000 over 10 years. The problem is if Echo dies before it's paid, all of those remaining payments, $900,000 in capital gain, are accelerated into 1 year under Internal Revenue Code Section 453B2. That's up to a $334,000 tax bill. But here's the kicker. Echo sold that property, does not have the money, has a right to collect money, but is only getting $100,000 a year. So the estate's going to have to come up with money to pay, right, the tax associated with those future payments. So installment sales can be tricky. I would say if you're watching this video because you've Googled installment sale, income in respect of a decedent, what can I do? It can be a very difficult place for many people to be in, especially if there's not liquidity in the estate, because those taxes are due 9 months after death. Okay. State inheritance tax and death taxes. So state inheritance tax, what are we talking about here? We are talking about the hidden tax that certain states impose. So the federal government imposes federal death tax at 40% in 2025. The state death tax is levied on the total value of a deceased person's estate before it's distributed to the heirs if they are a resident of that state, okay? So it's paid by the estate rather than the individual. If the inheritance tax is paid by the individual, and we'll cover that in a couple of slides. States with the state taxes often have a threshold amount, meaning we're not going to tax anything under $1 million, which is Oregon, but Oregon taxes everything over $1 million at up to 16%. Washington, they say we don't tax anything. It's a little over $2 million, but everything over that is taxed at 20%. So these are not small numbers. So you may be in this weird spot where you may have a $5 million estate and you're not paying any federal estate tax. But if you're an Oregon resident or a Washington resident, your estate will be paying death tax, even though they'll pay state death tax, even though there's no federal death tax. And oh, by the way, there's a gotcha. If you're a California resident and you own a vacation home in Oregon, that is included and is subject to Oregon's inheritance tax as well. And if you're also thinking about retiring in California or Washington, or Oregon or Washington from California, bear in mind, they're going to have this estate or death tax. They might be great places to live in retirement, but you don't want to die a resident of those jurisdictions. And there are some ways around, if you have commercial property in Oregon, you can set up an LLC and turn it into an intangible. You just can't do that with personal use assets. And I would say that's broadly speaking the rule in many of these jurisdictions. There's a way around it if you're not a resident of that state. States with the state taxes, they have the threshold and the rates are progressive, meaning the more you have, the higher it goes. States with state, estate, or death taxes are Connecticut, DC, Hawaii, Illinois, Maine, Maryland, Massachusetts, Minnesota, New York, Oregon, Rhode Island, Vermont, and Washington are the states with the state death tax. The state inheritance tax is a tax imposed on individuals who inherit assets from a deceased person who are resident of that state. So the tax rate depends on the relationship many times. So sometimes it's exempt. If it's a certain dollar amount between parents and children, it's exempt. So these would be direct relatives. If it's remote relatives, it's a little bit more. Not all states impose an inheritance tax. And there are 5 remaining states with inheritance taxes: Kentucky, Maryland, Nebraska, New Jersey, and Pennsylvania. And these are, Maryland's a flat 10%. Maryland also has an inheritance tax and a death tax. So if you die a resident of Maryland and your children are in Maryland, and you're not only paying federal estate tax potentially, but state inheritance and death tax. So they tax you even more than California, shocker. But again, the rates depend, and it's a graduated system. So the key difference between the two taxes: inheritance tax is paid by the individual inheriting the assets. Estate tax is paid by the estate before distribution to the heirs. Estate inheritance tax rates vary based on the relationship. Estate tax rates depend on the value of the estate. So inheritance is looking at relationships. Estate tax typically does not. That's taxed on the decedent level. Inheritance tax is taxed on the recipient or the beneficiary level. And many states don't have any. California doesn't have any. Just don't tell anyone. Don't tell anyone in Sacramento that we don't have an inheritance tax. We got plenty of other taxes that kick in when you die, but not those. So increased property tax and loss of Prop 13 is a hidden death tax. Now, you may say, Jim, how can property tax be death tax? If you are inheriting property in California from your parents, you used to have a parent-to-child reassessment exclusion. That is gone, largely speaking, except for in a limited circumstance of a home that you want to live in and you actually live in within a period of time, you're losing Prop 13. This was passed in 1978. There was a tax revolt. 1978 was a period of high inflation, was a period of high interest rates, was a period of economic tough times. I mean, does this sound familiar? Right? Um, it amended the California Constitution. It rolled back taxes to their 1975 level. So it used to be the assessors would just reassess your property every year, and property really went up during that time period. This cut property taxes an average of 2.6% of the fair market value down to 1%. 1% is rather low. Now, property values are high in California, so that 1% tends to be a high absolute number, but it is still only 1% of the value of the property. And assessed values can only go up 2% per year. So if your property goes up 10% a year, they can't raise it 10%. Property's fully reassessed only when there's a change in ownership. This is a death, sale, gift, or certain LLC transactions. And we've got to have some examples here. So Abel sells Greenacre to Baker. That is a sale. That is a change in ownership. Abel's low property taxes go away. Greenacre, the property's reassessed to its fair market value. Greenacre is going to pay 1%. And there might be some local add-ons there that take that tax bill beyond 1% of the purchase price. Charlie gives Greenacre to Delta. Maybe or sells Greenacre to Delta for $1. That is a gift, okay? So if you sell something for $1, the difference between what somebody actually paid and the value of the thing is a gift. So it's a taxable gift. Sorry, spoiler alert. It's very important to understand that even though there's no reporting of a value on the property, so in a sale, you're going to report the value, you're going to pay a documentary transfer tax, which also known as the mansion tax in LA. It is typically about 0.5%, a little over 0.5% for all transactions in California. It could be as high as 4 or 5%, 6% in San Francisco. That's on a sale. You report the value on the sale, and many times if it's what we call an arm's length transaction, so if it's you selling to a stranger, the assessor is going to go off the sales price. But when it is a family member or a gift, they're going to have their own assessment of the value. So they're going to send out essentially their own appraiser, and they're going to assess the property based on its market value. So they'll have to determine that market value. So it's not, some people say, well, can I just give the property to my kid and get around reassessment? No. And then certainly Echo dies, leaving Greenacre to Foxtrot. Now, this is very important. Death is the change in ownership. When Echo's heart stops beating, the date that is on Echo's death certificate is the date of the change in ownership. It is not the date that you report the death to the assessor. It is not when the property is distributed from a trust or a probate estate. It is the date of death. And this, I think, trips people up. And we've covered that in other webinars, but bear in mind, if you're trying to do trust administration yourself, you're probably going to want a lawyer on this one to say, hey, I want to make sure I'm distributing assets as a trustee. I just want to make sure I'm not screwing things up. This is where you want to kind of figure out what your supplemental tax bill will be, because you probably aren't going to get that for about 11 months after reporting the change in ownership to the county. So, mom dies. 6 months later, you report it when you're selling the property to the assessor's office. They may take a little under a year to give you a supplemental unsecured, where they're going to say, hey, there's a little bit more tax that's due, because they haven't quite figured that out, right? If you notify them and you're kind of selling the property at the same time you notify them, there's just not enough time for them to issue a new tax bill. If you're handling your parents' estate plan, your siblings want their money, you're inclined to distribute all the money, but you may end up with a pretty hefty tax bill maybe a year after you notify the assessor. So you're going to want to make sure and get legal counsel on that, so you're not ending up holding the bag on that. Prop 13 is a very valuable property right. So it limits the assessment of property to 1% of fair market value as of the date of acquisition. Again, this limits the increase to no more than 2%. Over time, for many Californians, this has become a very valuable property right, because since Prop 13 is passed, real estate's gone up about 6% a year on average in California. Well, that 4% delta is not getting taxed, so that is money in your pocket. So you want to make sure that you preserve the Prop 13 taxes as long as possible. Sierra and Tango buy a condo for $24,000 in 1974. Their taxes are now $800 a year. They paid $24,000 for the property, and the property tax bill of $240 has gone up 2% a year. Now that's $800 after 50 years. Their next door neighbor, same condo, same square footage. Allegedly, every piece of real property is unique, but these condos kind of look the same. Their taxes are $6,000 a year. Now, the people who pay $600 say that's not fair. The people who pay $800 say it's not fair that just because stuff went up, I got to pay more tax. I don't know how to resolve that, but just bear in mind, you may be inheriting a condo with an $800 tax bill, and you might get a supplemental unsecured bill for $3, 4, $5,000. And if the property is, if it's you add a zero to that, then that tax bill gets that much bigger, right? If it's a bigger home. Preserving it for your loved ones before 2021, we had a parent-to-child reassessment exclusion, largely gone. With Prop 19, it went away. There were methods of preserving your low property taxes. There are methods to preserve your property tax one-on-one basis, or at least half or 49%. But that's something we talk about one-on-one with clients. So for many clients, you might have a unique set of facts that allows you to transfer that property from one generation to the next without having it reassessed or not having it fully reassessed. So that's something we can talk about one-on-one. So keeping your Prop 13 tax, you can move your Prop 13 tax base to another California residence. So people who are victims of a wildfire, and as we're recording this, there are big fires in LA and very tragic. And a lot of people are going to be in a very difficult situation. You're able to move your Prop 13 tax base if you're the victim of a wildfire to another property, regardless of age. But certainly if you're 55 or over, you can move your tax base to another residence. That is one case for staying in California in retirement, because you can have a pretty nice place to live. You can move maybe to a location or a property that suits you, and you can take your low Prop 13 taxes with you. So the property you are selling, though, has to be 100% reassessed. So if you own a partial interest or whatever, or you're transferring it to your kids and you're picking up the limited parent-to-child reassessment exclusion, you can't daisy chain these together. The purchase or sale has to be after April 1, 2021. You must have acquired or sold the properties within 2 years. So those transactions have to be within 2 years, have to be 55 or over. And this is in addition to a one-time transfer. Abel and Baker sell Greenacre for about $1.4 million. They have a $500,000 capital gain. The sale of Greenacre results in a full reassessment. Because Abel's 55, they move their property tax base to another residence anywhere in California. Abel reaches out to Cunningham Legal, and we're able to work with Abel to reduce his new tax bill. Because what happens is you sell your old property, you move to your property, you get this big tax bill, and you go, wait a minute, I thought I could transfer my tax base. What happened? There's some forms you need to fill out. Can you accomplish this on your own? Yeah, a lot of people frankly, are just nervous about doing it, or you're up against a time. You're coming up close on the deadlines associated with that, and there are deadlines. So that's something we do help people with. So key takeaways: Prop 13 can be a very valuable property right. You really should determine your goals. Do you want to keep these low property taxes? You might be giving up some other things. This is not easy stuff. Absolutely not a DIY process. This is not for the regular lawyer. It's for a special lawyer, a savvy lawyer, as I mentioned in my book, Savvy Estate Planning. The savvy lawyer. It's not too late to take action. You can't go back and change the beginning, but you can start where you are and change the ending. So wise words from C.S. Lewis. Avoidable capital gains tax is a hidden death tax. What am I talking about? Avoidable capital gains taxes. Well, what the heck are avoidable capital gains taxes? Well, what are capital gains taxes? If you buy something for $1 and sell it for $3, you're going to have to pay tax on that profit of $2, right? That's the basic idea. For 2025, and a lot of people don't know this, for 2025, if you're a single filer and your income is $48,350 or less, or $96,700 as a joint filer or less, your federal capital gains tax rate is 0. You don't have to pay any. So we had this installment sale example, and that made sense because with the installment sale, you're getting taxed at 0, 15%, not the full 20. So then it goes to 15% on anything between 97,000 and 600,000 if you're a joint filer, and then anything above 600,000 is 20%. Remember, federal recapture of depreciation is taxed federally at 25%. So that 20% is 25 if it's recapture of depreciation. California has no capital gains tax. It is all income. There are 10 brackets. I'm not going to bore you with all the brackets. I don't know why we have 10 brackets in California. Go figure. But it's all considered income. So Delta buys Greenacre in 1994 for $375,000. The property's fully depreciated, and the cost basis is $100,000. Delta sells Greenacre for $1.375 million. The $1 million gain, $1.1 million gain, is taxed at a maximum. A $1.275 million gain is taxed at a maximum 30. Well, let me back up. The capital gain itself is taxed at 37.1%. The recapture, which is the 275, is taxed at a higher rate. So 25 plus 13.3 plus 3.8. So the taxes are about 486,000, which is about 35% of the sales proceeds. But if you index this to inflation, and please think about this when you're thinking about taxation, it's an 83% tax. So if we had gone back and we had factored inflation in 1994 and figured out, and here's the problem with holding capital assets for a very long term. If you're going to sell those assets, please pay attention to the tax consequences, because you may find that most of your gain ends up going in tax. And there are ways to spread that tax over multiple tax years, so that gain over multiple tax years. There are ways to avoid it entirely. There are a lot of different things you can do, and this is really the purview of, again, the savvy estate planning attorney, which we talk about in our book. So capital gains tax is actually more than income taxes after factoring in inflation. Well, let's look at adjusted cost basis. Delta buys Greenacre in 1994 for $375,000. It's fully depreciated, and then Delta dies. Well, Echo gets a full adjusted cost basis on the property. What does that mean? Well, that means that gain is totally gone, right? That the tax on that gain is gone. So the asset's still there. It's like a magic wand is waved over the property. And because Delta passed away, and because that asset was included in Delta's gross estate, so those are the magic words, because the asset was includable in Delta's gross estate and included in Delta's gross estate, it gets a full adjusted cost basis. This means that Echo can either sell the property or picks up more basis in the property and keep the property, even though the property taxes might have gone up. There's such a huge income tax benefit to Echo. Echo may be ahead, right? Maybe ahead with this new basis, new depreciation, right? So Echo will be able to depreciate a lot more. And I guess the moral to the story on this is, how do you avoid screwing this up if you're Delta? If Delta were to give Echo the property during Delta's lifetime, Echo gets Delta's low cost basis. So the moral to the story is, don't give low basis assets, right? So India bought Blue Acre in 1993 for $375,000. The property's fully depreciated. India dies. Juliet, India's widow, sells Blue Acre right after India dies for $1.375 million and pays no capital gains tax. This is community property. So if you're married, so India and Juliet are married, India dies, it's community property. Juliet gets the same benefit as if Echo, right? In our case with Delta and Echo, where Echo was a child and inherited the property. If you're married, you really want to make sure that you look at this issue of community property. Now, where this gets a little dicey is when one spouse has separate property. When one spouse has property that's not community property, that's separate property, it can get a little dicey. But you want to make sure that you don't have assets titled as joint tenants, because you don't get this benefit, and we're going to talk about that in a little bit. So if you don't live in a community property state, so California is a community property state, Colorado is not a community property state, Florida is not a community property state, even though these were former Spanish, subject to the Spanish crown in colonial days. You can, if you live in a separate property state, opt into community property treatment, and there's some community property trusts. We cover that in other webinars. So tax tips: consider holding low basis assets till death. Avoiding lifetime gifts if you want to. I'm not saying avoid lifetime gifts, but if you don't have a taxable estate, right? If you have a $5 million estate, it does not make sense to give an asset while you're alive, just outright to somebody. Now, you can give someone an asset in a trust in a way that it's theirs and it gets an adjusted cost basis at death. And that's something we talk about in other videos, but that's something that we would talk about one-on-one. So if you do want to give somebody a gift that's a low basis gift, there is a way that you might be able to get an adjusted cost basis on that, right, at your death. Check on whether your state allows full adjusted cost basis on the death of a spouse. So if it's a separate property state like New York or Florida or Colorado, the answer is no. You only get a 50% adjusted cost basis, and get a savvy lawyer. The other thing to bear in mind is, if you've done an irrevocable trust, like a dynasty trust or some type of other irrevocable trust, most of those irrevocable trusts, 99% of them, you're not going to get an adjusted cost basis because those assets are outside of your estate. Basically, if you file a gift tax return, and that property's in an irrevocable trust, you're not going to be getting an adjusted cost basis. Failure to utilize the generation skipping transfer tax exemption is a hidden death tax. Now, before I lose you on that, because that is a mouthful, this is actually a pretty simple concept, a lot of words. And I want to use an example. So this is the wealthy family, the parents example. So Abel and Baker are wealthy. They have a $20 million estate. Abel and Baker have two children, Charlie and Delta. They leave their $20 million estate 50-50 to their children, Charlie and Delta. So Charlie and Delta each get $10 million. And you might think, well, Jim, the estate tax exemption is $14 million. This estate does not need any estate tax planning. Well, the problem is that Charlie has three children. Delta has no children. She's not married, no partner. Delta's going to leave her entire inheritance to Charlie. Now, could Delta leave it to Charlie's kids? Maybe. But Delta says, no, I'm going to leave it to my brother. So when Delta dies, Charlie survives. Charlie now has $20 million. He now has a taxable estate, right? Because the threshold's $14 million. So if Abel and Baker create an estate plan that keeps the inheritances of Charlie and Delta outside of Charlie and Delta's estate, it's going to save Charlie's estate $8 million or more in death taxes. So what I'm talking about here is if you're a wealthy, now, if Abel and Baker have 10 children and each child's getting $2 million, may not be that big of an issue. If Abel and Baker have one child, yes, absolutely be looking at this generation skipping, transfer tax exemption planning. And the problem that lawyers have is they come up with these names and they're almost like the opposite of what you would think. So when you hear generation skipping, you might be thinking, well, I don't want to skip my kids. That is not what we're talking about. We're talking about utilizing the $13.99 million coupon, which is the generation skipping coupon that allows you to leave stuff to your kids. And then when your kids die, it's outside of your kids' estate. Okay, so it goes to the grandkids and it's not taxed in the kids' estate. Very, very important concept. And we're going to cover why this is important. Now let's look at the wealthy child example. Echo has a $5 million estate and one child Foxtrot who has a $15 million estate. So this is very common, right? We have a lot of clients where their kids are significantly wealthier than they are. Echo creates an estate plan so that when Foxtrot inherits, Foxtrot's inheritance is not included in Foxtrot's estate. So Echo dies, Echo's inheritance goes to Foxtrot. Instead of just throwing that $5 million on top of the $15 million and causing a $2 million tax bill when Foxtrot dies, that is outside of Foxtrot's estate. And that $5 million passes to Foxtrot's children or beneficiaries free of estate tax in Foxtrot in the child's estate. So Echo, $5 million estate, leaves that $5 million in a trust. Foxtrot could be the trustee of that trust, right? Then Foxtrot has use of that money, control of that money. When Foxtrot dies, it goes to the grandchildren, let's say, without estate tax and saving the estate $2 million. Again, this is preserving multi-generational wealth. And I will tell you, so much wealth transfers between generations. I mean, just think about it in your own personal life. To the extent we can just cut a little bit that goes to the government, over time, that $2 million, that could end up being $10 million for the grandkids, right? So if it's invested properly. So there are two different types of skips. So generation skipping transfer tax applies to two. The direct skip, this is where you leave property directly to a grandchild or someone 37 and a half years younger than you are, which is the cutoff, all right? Right now, it's a 40% tax. Then it's a 40% tax plus another 40% tax. So if your estate's under 13.99 million, the taxable estate, including prior lifetime gifts, you don't have to worry about it. This is for 2025. Juliet leaves 23.99 million to her grandchild, Sierra. And the first 13.99 million passes tax-free. So Sierra inherits 13.99 million, fine. The remaining 10 million is taxable at 40%, so 4 million in tax. Now that leaves 6 million. But because Sierra is a grandchild, that 6 million is taxed again at 40%. So the tax bill is 6.4 million on 10 million. And it's going to go up to 69.75% in 2026 if the Tax Cuts and Jobs Act is not extended. Again, we covered that in other webinars. But remember, it's taxed twice. So you tax that first tranche, and then you have less, and then whatever's left over, you're going to pay another 40% tax on. That's a direct skip. So the dynasty trust is what we call an indirect skip, and this is what we talked about with Echo leaving the money to Foxtrot. With the proper dynasty trust, the estate taxes only need to be paid when that first death dies. So in our example with Echo and Foxtrot, where Echo had the $5 million estate, Foxtrot had the $15 million estate. When Echo dies, that $5 million is under the $13.99 million exemption. that can go to Foxtrot. That could grow to $50 million during Foxtrot's lifetime. And that's going to pass free of estate taxes. Now, you might have capital gains tax issue in there, but it's going to be passed free of estate taxes. So again, Able creates a dynasty trust, puts $14 million in it. Beneficiaries are Baker and their 3 children in a common trust while Able and Baker are alive. When both Able and Baker die, the property is split into 3 pots, and the property passes free of estate and death taxes, even though it's gone to $50 million. Joint tenancy is a hidden death tax. What am I talking about? Joint tenancy is a form of legal co-ownership where not one person, but it takes 2. Joint tenancy is 2 people or more have equal ownership in the property. So if it's 3 people, it's thirds. If it's 10 people, it's tenths. When one joint tenant dies, the share automatically passes to the other surviving joint tenant. So last man or last woman surviving, this bypasses probate. In many jurisdictions, the deceased joint tenant's share of the property is included in the taxable estate. So it's a weird thing. So if I'm a joint tenant with somebody else, the value of that joint tenancy property is included in my estate, and my kids have to pay tax on it, even though I may be owning the property with the business partner who ends up with the property. So a little bit kind of wonky. You need to pay attention to this, certainly if you have a taxable estate. This is why joint tenancy can be a little dangerous. Creating joint tenancy with somebody other than a spouse may trigger capital gains tax consequences, so not a full adjusted cost basis. So Able and Baker are married and purchased Red Acre as joint tenants in 2000 for $1 million. Able dies in 2025 and Red Acre's worth $3 million. Baker takes Abel's half through right of survivorship. So Able and Baker are married. Able dies. Baker gets everything because Baker is the surviving joint tenant. Baker, even though they're in California, and we covered this in another example, if this were held as community property, Baker could sell that $3 million asset tax-free. But Baker only receives a partial adjusted cost basis on the property. What does that mean? Well, it means if Baker sells the property for $3 million, Baker's going to have $1 million realization event because the basis was $1 million and the increase in value was $2 million, and you had one joint tenant die. So you only get a 50% adjusted cost basis. And that means up to $371,000 in capital gains taxes. If Able and Baker had titled the property in their living trust, not as joint tenants, and assuming it was community property, Baker would get a full adjusted cost basis. This is why funding your trust is so important, paying attention to it. I can't tell you how many times people take title out of their home, right? For whatever reason, maybe they have to, it's an insurance requirement or a lending requirement. What do you want? Joint tenancy. Okay, joint tenancy, whatever. And they don't think about it. Well, you're not going to get a full adjusted cost basis, and that can cause hundreds of thousands in taxes, potentially millions, depending on the size of your estate. Where your trustee resides is a hidden death tax. What on earth am I talking about? Where your trustee resides is a hidden death tax. This is going to be a shocker for many of you. But if you've lived in California very long, it might not be a shocker. California state tax implications of a California resident trustee. California taxes trusts based on the residence of the trustee and beneficiaries, quite frankly, but trustee. If a trustee is a California resident, it is subject to undistributed income and capital gains tax, and you have to pay California. So example here is Able, a Nevada resident, names Baker to serve as trustee after Abel's death. Baker is a California resident. All income and capital gain that is not distributed to a beneficiary is subject to California income tax, even though the assets are in Nevada. You could have Nevada beneficiaries, you could have Nevada assets, and just because you've named a California trustee, if you have a sale and there's a capital gain and income, if that money is not distributed to the beneficiaries, that will be taxable to California. So even though the only nexus is the residence of the trustee, very important, if you're a California resident and someone in another state has named you as successor trustee, you need to pay attention to this. Now, this is a big one. And this is one that a lot of estate planning lawyers aren't familiar with. There are U.S. federal income tax implications of naming a foreign trustee. Now, what is a foreign trustee? Well, first of all, a trust itself is domestic if it meets the control and substantial decisions test, which means having a non-U.S. resident trustee, even if that trustee is a U.S. citizen or green card holder, may convert this California trust or trust from another U.S. state to what we call a, quote, foreign trust. A foreign trust requires complex reporting. Domestic trusts are taxed on worldwide income. So if it's a trust in California, you're going to be taxed on worldwide income. Foreign trusts have limited taxation on U.S. source income. So there's some tax treaties in there. But once you are a foreign trust, you have special reporting requirements on your 1041, your 3520, and your 3520A. So those are some forms there. And here's an example. And by the way, this is a very common example. And when I was a younger attorney, I didn't know this stuff. Okay. I would say that less experienced lawyers just don't know this. I became a lawyer at 25. I didn't know anything. I mean, if you hired me when I was 25, I was really nice, but I know a lot more now after 30 years of practice. Let me put it that way. Charlie names Delta, a resident of the UK, to serve as successor trustee following Charlie's death. There are cross-border reporting. So this is an example of a foreign trust because Delta is a resident of the United Kingdom. Even though she's a U.S. citizen, it becomes a foreign trust. You've got to report not only to the U.S. Internal Revenue Service, but you have to report to UK Inland Revenue. That's their version of the Internal Revenue Service. Currency conversions, coordination between taxing authorities is complicated. Disputes over taxing rights comes up, and it gets very sticky very quick. But understand the penalty if you say, you know what, Jim, I'm just going to name my UK kid as successor trustee. If you don't follow these rules, it is a 35% tax on the assets. This is also in addition to federal estate tax, right? So you have to really tread lightly. So a $10 million estate, although not subject to estate tax, could be liable for a $3.5 million penalty if the rules aren't followed. So, and if it's taxable estate, it's even worse. So the moral to the story is, think twice before you name a foreign trustee. And if you're not in California, think twice before naming a California trustee. So what have we talked about? The 7 hidden death taxes: income tax and income in respect of a decedent, state death and inheritance taxes, property tax, capital gains tax, generation skipping and inheritance taxes, joint tenancy death tax, and the trustee residence, the foreign death tax. Our offices are located in Northern and Southern California. And what should you expect when you call? So if you call us and say, Jim, I'd like to hire your firm, this is great. Let us know if you're here to update an estate plan or create an estate plan, or if someone's passed away. Tell us your estate and tax planning goals. That's very helpful. Don't ask for pricing. Only lawyers can give pricing information. We do have several videos on how much should an estate plan cost. And don't ask for legal advice. Only lawyers can give you legal advice. And the goal is to set an appointment with a lawyer or not. You know, it may be like in talking to the person, it's not a good fit. But it might be. And I would recommend reading my book, Savvy Estate Planning: What You Need to Know Before You Hire the Right Lawyer, before coming in to meet with us, because we're going to be asking you a lot of questions that are in that book. If you're watching us on YouTube, please subscribe to our YouTube channel. And we are going to cover next time settling a trust after death, dissolving a trust. And that is with me on January 30th. So we will open it up for questions. If you're watching this on YouTube, another video will roll right after this one. And thanks for joining us.